In order for that to come in, we need to basically see more volatility in the actual market, in technology, in your Palantirs, their NVIDIAs, and all these other things that we've been talking about. Because at the end of the day, as a percentage of an investment asset class, just overall, miners are still small compared to like Magnificent Sevens or Palantir or whatever. I mean, that's just a fact. That said, they can produce 2x, 3x, 5x, 10x returns. And so as this demand, which is accelerating for gold, continues, there will be a necessity to source more gold.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have a wonderful discussion lined up. We're fortunate to have with us Dr. NOMI PRINS, founder of Prinsights Global. NOMI is a PhD economist, geopolitical financial expert, and best-selling author. She has held key positions on Wall Street as a managing director at Goldman Sachs, a senior managing director at Bear Stearns in London, a strategist at Lehman Brothers, and an analyst at Chase Manhattan Bank. NOMI is a trusted independent advisor to U.S. legislators on both sides of the aisle, nonprofit organizations, corporate boards, and universities. NOMI, welcome back to Metals and Miners. Thank you so much for joining us today.
Thank you, Gary. It is always a pleasure.
So 2 weeks ago, President Trump said he wanted interest rates to be lowered. In fact, he was demanding Jerome Powell lower the rates. Then Powell kept the rates steady. Trump was asked about it, and he said he thought keeping the rates steady was the right move. Now there is Treasury Secretary Scott Bessent saying on Fox Business the other day that he and Trump are focused on the 10-year Treasury. He's not calling for the Fed to lower rates. Clearly, there's a lot to consider here, but why the change in tone from President Trump about the rates?
It's a really interesting question and time. I think that going into this period of the Trump second administration, Powell still in play as the head of the Fed, the idea was sort of to take an old playbook out, which was we should have lower rates. Lower rates are stimulative. They're too high, etc. But I think we're in a different period of time now than we were last time, which is that we still have more persistent inflation, and that particular inflation isn't necessarily going to go away. I have never believed that the Fed has much to do with reducing actual asset inflation anyway, but be that as it may, it's more likely that the administration had a separate internal conversation about the relationship between the front end of the curve as the Fed presents it being applicable to fighting inflation and where the 10-year is. And I think that's why they pivoted to addressing the idea of the 10-year. That said, there's only a couple ways to get 10-year yields down. One is to dip back into quantitative easing, which is more of a Federal Reserve policy potential initiative. And that's one way to basically increase demand for the 10-year Treasury, which would reduce, in turn, the yield. We saw that happening even in the recent past with the Fed coming in and doing a bit more quantitative easing because of bank problems that we saw at the beginning of 2023 and so forth. It's available to them. But the same with the Treasury Department, the only way to really reduce interest rates is to increase demand for the U.S. Treasury. And the only way to really do that is to issue potentially less treasuries and sort of force a more squeezing of demand scenario. But we have such a high deficit, and we also have such a high interest rate payment on our existing debt that seems less possible as an avenue to the Treasury Department. But it is certainly a possibility.
So, I appreciate both of those. And, there are a lot of folks that are saying that they're expecting another round of QE, although the Fed has been, pretty staunch that they're wanting to let this thing play out. Are you expecting a big print coming from the Fed?
I think that we do have the potential for more quantitative easing. So although the Federal Reserve has created a quantitative tightening scenario. We're still very high in terms of the amount of subsidy or the book that the Fed is holding. It's still just under $7 trillion. That's still much higher than the $4.5 trillion it was in the wake of the financial crisis to help the banks and all of that scenario. It is less than what it was at the height of COVID. But again, it's a pretty high number. And we saw that number inch up even more so in the wake of Silicon Valley Bank and the failures that we saw in the beginning of March 2023. So I don't think the Fed is expecting to have to do QE, but at the same time, we are seeing some worrying information coming in from the banking sector. That includes in commercial real estate. Yes, that is generally a regional banking issue, but every major institution has a relationship with regionals. And in general, what happens in the banking sector does tend to have the possibility to overshadow just the regional banks if that is where the crises happen. We are seeing a lot of retail bankruptcies coming in. The footprint of the stores that companies have had in play, including banks, become reduced, which means that rental income into those loans becomes diminished, which impairs those loans. We've also already seen commercial real estate extended and reimagined in terms of new loans, which are also delinquent. And so there are possibilities in the banking sector for problems that would warrant the Fed to turn in and turn up their quantitative easing. And that's definitely something that can happen if there's a big enough crisis or enough of a liquidity concern that we see in any of these scenarios coming from the banking sector.
So a lot of cascading effects that could occur. The liquidity is a great topic of discussion here, Nomi. Some analysts are expecting liquidity to contract as this huge, almost $10 trillion debt wall begins to hit around mid-year, basically causing a collision of these two titans. Do you see liquidity contracting mid to late this year, and how important of an issue is that?
Well, the Federal Reserve disconnecting liquidity and Wall Street and that entity is really in existence to provide liquidity to Wall Street. That is basically why it was created in 1913. This idea of, this balance of full employment percentages relative to reducing inflation and doing that dance is really something that's relatively new to the entire makeup of the Federal Reserve. It remains a liquidity producing, subsidy providing entity to Wall Street. So the reality is that Wall Street has had a period of time, includes regional banks up through the majors, where they've been able to extend loans to deal with this higher interest rate environment and to rejigger things such that they look better on the books. So that means they haven't had to necessarily reevaluate collateral, especially real estate and office type of collateral. But all of those loans, all of that extension that banks have provided to finance everything from mortgages to commercial to autos to credit to so forth, is still in play at higher interest rates. This is where the 10-year we were talking about has come in. There hasn't been a reduction in long-term rates to alleviate what could be a liquidity crunch. How can that manifest? Well, it can manifest when loans aren't paid on time or at all in terms of either delinquencies or defaults, and that can hamper banks' ability to issue more loans or provide more liquidity to the system and to themselves and to each other. Can we see that come to a head in the middle of this year? We absolutely can. Can we see it towards the end of the year? We absolutely can. It only takes one or two major bank statements of repositioning their loan losses. We didn't see it this quarter. But it only takes one or two of those to really spook the entire banking industry for it to require more liquidity to keep its functionality going and to keep its concerns from becoming too big. And we are facing that possibility. New York Fed itself talked about how banks were, quote, extending and pretending on loans and basically pushing forward the evaluation, pretending or hoping that more payments would come in than might actually come in on those loans. So any of that scenario can create a liquidity crunch for the banking sector that can have more ramifications for corporate bankruptcies, for small business bankruptcies, and so forth in terms of their own financing, not to mention the financing of the United States Treasury, which is still over $1 trillion per year in terms of interest rate payments.
So yeah, and to your point, delinquencies have been rising. I had a conversation with Melody Wright on the mortgage side with commercial real estate and residential real estate, and she's seeing delinquencies rise. I mean, so that's going to put a strain, just like you were talking about. I want to switch over here to the markets. While OpenAI kept their tech locked down, DeepSeek, which I know you've heard about, I know you've written about, they threw their doors wide open. They made the code free for anybody to use. It's all open source. So now anyone with a half decent computer can basically tap into the cutting edge AI without needing billion-dollar infrastructure or costly cloud services and have a shot at building something special. Well, at the same time, Amazon, Google, and the rest, they're saying that they're going to spend 60, 100 billion in CapEx this year alone. Are the moats that the giants like Apple, Google, Meta, Microsoft, et cetera, that they've enjoyed, are they as secure today as they were even a few weeks ago pre-DeepSeek? And if not, what are the risks here?
Yeah, so what happened with DeepSeek, there's still a lot of gray area in terms of how much that really cost, to what extent the Chinese government was really involved, and to basically what magnitude that application had in terms of the cost of its development versus what might have been projected by the markets, by the Chinese hedge funds that were allegedly supporting it, and the only one supporting it, to a tune of $6 million, which seems a bit light. Yes, compared to the CapEx that companies like Amazon and Google, Microsoft, and so forth are projecting into this space. With respect to AI in general, AI is always only as good as data in, data out. And to the extent that DeepSeek is a better data trap, i.e. it's something that can learn more effectively, that it's something that can actually qualify the data that it's analyzing, that has yet to be determined. Similarly, for the larger US companies, it isn't to say because they spend more money that their data has better quality or that their AI has a better learning curve, right? So there's still a lot, I think, that needs to be explored in the AI space before we can really, or I can certainly make a determination as to whether or not that cost for that level of AI and that potential of DeepSeek to be that sort of new arbiter of AI, yes or no, can actually be that much cheaper and better, and all of those parameters than an Amazon or a Google. That said, what we do know is that when we are processing data, there are certain ways to do it. There's through the cloud, there's data at source, there's moving data back and forth to the actual mechanisms that are doing the computing power. And to the extent that DeepSeek has a potentially better mousetrap for that, it can be cheaper and more effective in terms of the energy that's required to process data. That is something that I think companies like Amazon and Google have been and need to be investing in more so they're not simply building data centers, which they are supporting, which they will continue to do. Microsoft stepped back from one of their data centers and so forth. They will relook at their general cost footprints, but they also need to become better at source processing of data. And I do think that is something that they're actively working on. And that's going to make a difference in terms of how that manifests in AI.
And those are all fair points. I think the question that I'm really trying to get to here is whether it's DeepSeek or another company. To me, it's irrelevant that it is DeepSeek in this case. But did DeepSeek throw a grenade into the mix here, where now anybody could conceivably cross the moat that the Mag 7 has built around their AI, that has been perceived that they've been the leaders and that there's really no competition out there? But now, are they basically saying, look, it's not that hard to compete here, and maybe the lead, the moat, the security of what the Mag 7 has put together is a little bit more delicate in the eyes that the investors should be seeing it that way? It's a little bit more delicate than maybe originally perceived.
Yeah, I mean, I do think, and as I mentioned, there's a difference between the type of data, the integrity of data, the processing of data, the learning of data, the positioning of the data that is processed by any AI application, and the openness of that AI application itself. So what DeepSeek is showing is that there does need to be more competition. Again, however much that actually cost for real, whatever the government participation was for real, putting all of that aside, that these other companies have to take a closer look at the cost elements of processing data, because that's basically what this is open, the idea of processing more cheaply, more effectively. The data itself, how that data is qualified, where that data lives, how much of it is used, how it's assessed, all of that is really a bigger part of the equation. And it's not to say that Amazon or Google have all of the answers and the best quality and analysis of the data that they have access to, but they do have access to an awful lot of data by the types of systems that they have produced over years, where it's located, where it lives in the cloud, and so forth. And so there's two things going on here. There's one, the processing of it, which yes, can be cheaper and more efficient. And then there's the other part, which is the data itself, that you need something to process. You need something for the AI to basically navigate and work upon in order to be the best possible level of AI. And that requires that data storage, those data centers, and that data awareness. And also, yes, a way of more efficiently and more cheaply processing it. But there are two different things going on here: the data itself and the efficiency of processing the data.
I appreciate that detail. So, Nomi, let's talk about the electrification and the grid build out and things like that. China has grown its grid capacity 134%. At least that's what's been reported over the last decade. And their electrical generation has jumped on average about 9% a year, year over year, since 2017. In contrast, the US has grown its grid 11.6% in the last decade. And to make matters worse, its transmission line growth has been slowing since 2017. Is China much better positioned than the US for the AI, robotics, electrification of everything movements? And if the US has a lot of infrastructure spending ahead of it and development ahead of it, while China doesn't have quite as much, what does that mean for the technology development, the growth, the metals and minerals acquisition that's needed? And finally, could this be why Trump is virtually trying to annex Greenland, Canada, and the Ukraine?
Those are all excellent points, and in this is this bigger field of electricity generation and upgrading U.S. power grids. And so to break all of that down, we are substantially behind at developing power grids, that can withstand shocks in terms of energy, that can withstand shocks in terms of weather events, that can withstand the growth in data centers, and not just because of AI, but because of all the myriad of ways that we process data. You know, whether it's a GPS or watching a movie or whatever it might be, there's a significant amount of, whether it's Bitcoin, I mean, there's a significant amount of energy that's required in processing data. And we have been particularly bad as a nation at upgrading our grids over time. And what China has been able to do is harness basically government spending in such a way that it keeps up with their vision and the actuality of how much energy they require to run the country as technology develops, AI develops, as their population grows. We have had a situation where just by a minimum number, back-end envelope number by the Army Corps of Engineers, they require $550 billion just to get our grids to basically base camp, in terms of not even anticipating new growth, but to effectively run well in terms of old growth, because of old growth electricity, because we have had, in many cases, grids not redeveloped or re-updated in 50, 60, 70 years. We have significant problems in terms of the efficiency, the safety, and the growth in our power grid system. And so when we expand this further into what happened under the Biden administration, what's happening now under the Trump administration, there's definitely a bipartisan acknowledgement that this country is behind in terms of power grids. In fact, in the first day or two of executive orders that President Trump put out, there was a recognition that we are in an energy emergency. Right. And part of that energy emergency, part of the actual language in there, we have this up on print site, had to do with the specificity of power grids and transmission lines. So there is an acknowledgement through multiple administrations on a bipartisan basis that we need to do something that China doesn't have to go through sort of the steps for, because it's just financing the growth and development and the upgrading of its electric grid. So now if we expand that into the metals, into the rare earths, into the applications of commodities that are necessary to both build a grid, harness power, expand our power, and bring it to the demands of anything from data to AI to travel or whatever we need or defense, whatever we need as a nation, then that's the next piece. So there's a couple ways of looking at that. If we're looking at the fact that we have a dramatically low processing capability for rare earth materials, 90% of which are processed in China, 60% of which are sourced in China, then the sheer standpoint of making the magnets that are required, whether it's from a battery storage perspective or whether it's from a satellite perspective or whether it's from technology and communications perspective, we are basically limited in how we can grow just the end product development. That's where Ukraine comes in. That's where Greenland comes in. That's where this idea of expanding upon our domestic supply comes in. If we look at other types of power, like uranium powering nuclear energy, 20% of our electricity comes from nuclear energy. Nuclear energy is a way more efficient base load energy than solar or wind on the one side, or the natural gas or oil or other fossil fuels on the other side. It sits there on a very particular point. That said, we also need to basically extract and process uranium, which we have received from Russia, from Kazakhstan, from other countries, and which last year Congress voted to effectively protect as a national security matter in terms of uranium for nuclear fuel. The Trump administration hasn't specifically discussed uranium in these last couple of weeks. It has noted that it might add uranium to its critical mineral list. In fact, I believe you covered that when that was first noted recently on Metals and Miners. And if that's the case, it's an acknowledgement that in expanding what we need in rare earths and those types of materials, we also need a very particular form of energy material, which is uranium, and we need that to be, yes, domestically supplied, as Congress has already acknowledged on a bipartisan basis, but also to protect going forward and make it a critical mineral in terms of our national defense and our energy efficiency. These things are in play. But again, going back to the power grid, if you don't have the best way of transmitting the power or storing the power that you need to transmit to your end needs, to your end demands, then all of that equation becomes more expensive and more complicated.
Okay, so there's a lot to talk about there. What I want to focus in on, though, is the executive order that you touched on about unleashing American energy and the metals and minerals component there. There's details in that executive order that don't just talk to actions and funding, though. It goes beyond that. And one of its instructs, it says, the Secretary of the Interior shall prioritize efforts to accelerate the ongoing detailed geologic mapping of the United States with a focus on locating previously unknown deposits of critical minerals. The Secretary of Energy shall ensure that critical mineral projects, including the processing of critical minerals, receive consideration for federal support contingent on the availability of appropriated funds. So it sounds like they're trying to identify where all of the critical minerals reside within our borders. That would presumably be the start before it's time to throw money at going to get them. Are you expecting at some point here in the point moving forward that U.S. soil is going to become the global leader in mining critical minerals and metals?
So a couple of things in that, and yeah, that's the language in the current executive orders. Now, the original, the first Trump administration was the administration under which the critical minerals list was first established. At the Department of Interior and the Department of Energy. So this idea, and that's the mapping that you're talking about, and it's been expanded in this particular executive order. So that idea of mapping the locations of where we can source whatever is labeled as critical mineral, if that includes uranium, if it's rare earths, if it's the combination of the 50 that's in there, or it goes greater than that number, that all has its base in something that happened basically during the first Trump administration. And so some of those maps actually are in existence because they were developed by the Department of Interior at the instruction to the Department of Interior at the time. And so there are places in the United States, in Utah and Montana, in some parts of Washington, parts of California, et cetera, that do have a mapping in the Department of Interior's jurisdiction and the Department of Energy of where some of those are actually located, the mines for which they're located, and so forth. So that, I believe, will expand or accelerate in this iteration. So definitely that will be a thing. Now, processing is some of the issue as well. Some funds for processing of rare earths and other critical materials did come from the last couple of NDAAs. So the last couple of the authorization acts for national defense. And I believe that in the last one, the one that currently is in effect for 2025, so it was basically passed before this administration started. They already added language relative to older ones to encompass funding some of the processing or more of the processing for domestic critical minerals. So the good thing in terms of what we need to do in terms of getting the funding to the right places is it's already been allocated for this year by virtue of new language that was put into the 2025 NDAA. So what I believe will happen is that as this administration gets rolling between the Department of Energy, Department of Interior, and what's already allocated, we might see more funding come for processing and for companies that not just have access to materials underneath the ground of the United States or with partners that are their allies in different places, but that we're also going to be able to bring those materials home or into United States borders to be able to process them and to grow our processing capabilities. To the extent that happens, it's going to require more focus from the administration than just we'll find the funds. But the funds exist, at least for a year. They have been sort of pre-allocated. And so I think if they combine taking those funds to processing companies and sourcing at the same time, we will be able to turn a little bit upward in terms of how much we have been behind also in the extraction and processing of rare earths relative to China. And that should help us. And I do believe it is a focus of this administration. It was a focus of them the first time around, different people, but Trump 1.0, as well as on a bipartisan basis throughout the Biden administration.
Well, that's all very encouraging, I got to be honest. So, Nomi, new Secretary of State Marco Rubio, he was recently explaining how trade deals in currencies outside the US dollar are now a regular occurrence around the world, and that in 5 years' time or so, the US is going to lose the ability to sanction other countries because of this end around of the dollar. How much of an issue is that loss of control for the current administration in terms of, maybe forcing them to get some kind of new monetary framework deal done before the clock runs out, so to speak? And what would this deal look like in your analysis?
That's an awesome question. Marco Rubio is correct in his assessment that to the extent that payment platforms continue to evolve in order to enable non-dollar based payments to, in lightning fast terms, be involved in transactions across countries, across the world, and not in US dollars, to the extent that continues to grow, which it is, the ability just to process and to transact and to facilitate payments in dollars will be diminished. That's just the reality of the math. And that does not mean the dollar is going to go away. It doesn't mean the dollar is going to be replaced as the reserve currency throughout the world. Things don't happen that fast. That's not something that's going to occur in any way, shape, or form during this particular administration in 4 years. However, and I was privy to a lot of these conversations when I was in Rio during the outskirts of the G20 last in November, which are continuing to happen, which is that payment systems, which are the bedrock of being able to trade in any currency, right, to establish funds going back and forth immediately and being convertible into whatever currency is involved or multiple currencies or whatever, however robust those systems are ongoing. And they are going to be connected to an extent more and more to central bank digital currencies, which are going to be connected to the People's Bank of China. There's already prototypes, which are going to be connected to the Central Bank of Brazil. There's already prototypes, which are going to be connected to the Central Bank of Russia. There are already prototypes, and they all are talking to each other and being tested. So this isn't something that might happen. This isn't something that's not in play. This is something where there are significant prototypical and growing platforms being established as we speak to allow the facilitation of transactions not in US dollars. What can the United States do about that? Well, they can't necessarily stop these systems or stop the ability of countries to trade with each other, or to have multi or bilateral trade agreements with each other. They can tariff transactions that don't happen in US dollars, but there's really only so much that can really go. If you're going to be going through a payment system that could possibly transact in multiple currencies in a nanosecond and you can't even trace them, right? I mean, there's various different ways that this can go down that you cannot control. But what the United States can do is be involved in some of those platforms. So at the end of the day, if it wanted to, you're not just talking about a swift banking platform of instructions on payment systems that go out throughout the world between banks and central banks that can be sanctioned, as we have seen, but that you're involved in the development or the prototyping or the testing of these. Now, the United States actually is, as it happens, involved in one that the BIS is currently developing, which is a payment system, which also is in prototype mode, which is more centric to the US and G7. So there are things that the United States is involved in, and it will be interesting to see to what extent it maintains involvement so that it actually can be privy to the developments of these payment systems so that potentially simultaneously better, higher, faster quality payment systems are being developed, but one of them actually includes the US dollar.
It will be interesting indeed. Okay, so NOMI,
times. I mean, this is just all very interesting.
It's incredible. It's really incredible. So NOMI, President Trump, you were talking about the tariffs. He's threatening tariffs on almost every country on earth, and he's clearly using the tariffs as leverage towards this broader negotiations because of this new monetary framework, that's going to come into existence at some point that we're talking about. One way to fight tariffs is to devalue the currency, and the Bank of Canada, they've already started that last week. They cut rates. They ended QT. Treasury Bissent, he came out after and he said currency devaluations is not what the U.S. wants. I don't know if he could stop that. But despite that, should we be expecting a massive race to the bottom in, worldwide in terms of fiat currencies as President Trump negotiates the trade war? And if so, do you see the beneficiaries basically being gold and silver?
So last part of that first, yes, I do see the beneficiaries of that being gold and silver, and sort of leg into the rest of what you had asked. From a gold and silver basis, particularly gold, what we have seen is the second phase of what we saw with the first tariffs back in 2018. So what do we see back then? First of all, rates were much lower than they were now. They were at 200 basis points lower than they were now. Inflation was oddly similar to what it is now in PPI terms. It's not the best measure. It's not the only measure, but just on a graphical basis, pretty similar. Inflation, lower rates. But then tariffs came in, and there was a sort of conversation fight between Powell and Trump about Powell being concerned back then about tariffs increasing inflation, Trump really wanting lower rates at the time. Ultimately, rates went from 2.5% down to 1.5% going into 2019 before COVID. So ultimately, rates were reduced. Tariffs did kick in. There were inflationary pressures, not massive, but on a lot of prices for a lot of different goods in the wake of tariffs. But the bigger thing that happened with respect to gold was that the People's Bank of China reinitiated their selling of United States treasuries. So going into that period, they've been holding about $1.3 trillion worth of treasuries. They're currently holding about $750 billion. So they've really diminished the amount of U.S. treasuries, U.S. dollars they are holding to liquefy international banking transactions that go through or that require the central bank to be involved. That's what they have done. In the place, they have purchased gold, not in a straight up line, but they've certainly increased the amount of percentage of gold reserves that they've had from under 2% to over 5.5%, particularly in the last few months. They sort of ratcheted up their gold purchases. They're on a path towards 6%, 7%, so forth, reserves in gold over the next 1 or 2 years. That would be consistent with what happened in the wake of the last tariffs. So do tariffs cause diversification of reserves and debt to gold? Yes. Are we in a period right now where more tariffs and potentially more volatility and uncertainty surrounding those tariffs will accelerate that move to gold? Yes. Why? Because everyone was at this movie last time, right? So there's already preparation, there's already a reduction in U.S. debt, and there's already an increase in gold reserves and the desire to continue gold reserves. And as I mentioned, in the technology of payment systems to be able to transact not necessarily in gold, but to potentially have gold back some of them and transact in other currencies or under central bank digital currencies. So all of this is a kind of tit for tat global version of what can manifest and has manifested when tariffs become a political item or even a political and economic and geopolitical item. This doesn't mean they won't continue to be pushed by the administration, and it doesn't mean there won't be retaliation from the other side. And there can be diminishment, as you noted, with Canada and with other countries, depending on their own inflation scenarios, of interest rates and of currencies in order to accommodate the additional cost or competitiveness of tariff wars. And we did see that also last time around. So there's definitely the possibility for the dollar to sort of remain stronger, other currencies to weaken in this new iteration of a tariff fight, and also gold to appreciate relative to those currencies and to the dollar.
Yeah, and I think the big unknown that you just pointed out is the retaliation. I mean, we just don't know how these other countries are going to really retaliate. And you would think that China has something in their bag that they could pull. So, Nomi, the GDX and the GDXJ, they're both up between 15 and 20% since New Year. Do you see this setting up to be a big breakout year for the miners finally?
Another excellent question. I do. I don't think, again, that's going to be a straight line. And I do think it's going to be necessary to choose miners that are very close to high quality production of their mines versus, ones that have those mines in a sort of back burner state or whatever it might be. There's going to be an order to this. The thing with the mining index is that it's basically a catch-all for all sorts of miners. So you're going to get your Agnicos in there, which are doing phenomenally well, hitting new highs right alongside gold. And then you're going to get other miners that aren't, and then you're going to get smaller miners that are hitting really well, like an Artemis or something like that on the smaller mine side, and then you're going to get ones all in between. So where do we pick up that sort of Western investor? Now it's time for mines again that we did see pop out last October to an extent before the election, before gold traded off a little bit. Now it's back up at highs. When are we going to see that come in? And in order for that to come in, we need to basically see more volatility in the actual market, in technology, in your Palantirs, their NVIDIAs, and all these other things that we've been talking about. Because at the end of the day, as a percentage of an investment asset class, just overall, miners are still small compared to like Magnificent Sevens or Palantir or whatever. I mean, that's just a fact. That said, they can produce 2x, 3x, 5x, 10x returns. And so as this demand, which is accelerating for gold, continues, there will be a necessity to source more gold. Last year, what we saw was not necessarily that necessity yet. We saw those miners in the overall index pop up a little bit because of the expectation that since gold had already popped up, it would bring up all of the balance sheets of all of these miners quickly enough, and that didn't happen quickly enough, so we saw a bit of a sell-off, and that's where we're at right now, which I personally think is a big opportunity. I mean, right now, we're looking at a lot of smaller cap and middle cap miners because of preparing for the eventuality that if I look at the numbers, going back to the tariffs that we're talking about, PPI, where gold was, where China was, where central banks were, where geopolitics were in 2018 relative to where we're at now, which is with so much more momentum for gold and so much more momentum for these things to expand outward and to magnify, is that I see gold going towards 4,000 towards the end of the year and towards 5,000 within a couple of years, basically just with all the math staying the same and all these parameters basically staying the same, and only China leading the way and going up from 5.5% of reserves to 7.5% reserves in 2 years and continuing this path for all of these reasons. And then everything else, all of the other reasons filling in. That's going to necessitate not just the central banks who are buyers of physical gold, not just their countries, their citizens who do what they do and buy physical gold or physical gold ETFs, which they are, but also it will require the miners that have high quality mines that are prepped and ready or already operating to be examined as the next part of that equation. So whether that is in 6 months or whether that's in a year, this is when you prep for that. This is when all of that impatience that people who do invest in mines, and it takes a minute to turn on a mine and create product and processes it in connection to demand. The same for silver, copper, uranium, etc. This is the time where you just kind of got to dig in and diversify your portfolio with the appropriate miners, and you will see that within, I would say, a year or so, you're going to see those indices overall pick up, whereas in between, you're going to see specific miners outperforming others.
I could really feel your positive energy and enthusiasm for where things are right now. It's really coming through. So that's exciting. All right. So today's silver market, it's facing unprecedented pressures beyond traditional industrial uses. We're seeing explosive growth in medical applications, high-tech electronics, semiconductor manufacturing, solar panel production, electric vehicle infrastructure, emerging solid-state battery technology, advanced weapons systems. But here's what makes this time different. We're on the cusp of a robotics revolution. From home cleaning robots to industrial automation and autonomous mining equipment, the coming wave of automation is going to require massive amounts of silver for solid-state batteries and electronics. Add in the growing energy storage needs for wind and solar power. We're looking at structural demand that dwarfs anything that we've ever seen before for silver. Has there been enough investment into silver mining production in order to meet these coming unprecedented pressures? And if not, what are you expecting to happen in the silver market?
Yeah, so I mean, it's a similar story to gold, except instead of looking at central bank buying, we're looking at all of these industrial demands that are magnifying, right? And there is, to an extent, a little bit of central bank buying because you can buy silver and use it as a reserve, but that's minor. Exactly, in India. But the point being that as you've listed, there are a significant amount of silver products that do not have the appropriate supply of silver to manifest the growth and the momentum of the growth of their demand. And that's not going to go away. I mean, it's like saying China's going to sell all its gold. It's just not. right? There are certain things. So robotics are not going to stop. Medical uses are not going to stop. We're not going to stop requiring more industrial building in order to facilitate whether it's cars or data, or permanent magnets, which require both, rare earths as well as the silver to actually create the manufacturing footprints and so forth. You're just not going to have that stop. We're not in a position from a sheer civilization standpoint where this stuff is going to go backward unless, the earth is hit by a meteor and it's game over for everybody and like other stuff happens. But as long as we're in this growth period, which we are, then little things, and this hurt silver to an extent last year, little things like, oh, is our economy going to grow as fast? Is China's economy going to grow as fast? Things that sort of ding at silver or sometimes copper, which pop up, but they're periodic. That stuff's not going to go away. But the overall trend, the overall necessity of more silver than we actually have out of the ground yet, is going to continue to pull demand for that silver. And it's, again, similar story to gold, which you're going to have silver miners who have quality silver. Quality extraction services are in areas of the globe where there's more peace and there's more of an ability to, not have external issues of chaos sort of pop into the mining situation. All of that is going to make miners of pure silver, high quality silver, in peaceful areas with appropriate technologies to extract and process at the top of this heap. And that is where you do look at these miners. That is where silver, silver's had a great run up this month. Again, it was dinged a bit at the end of last year for these reasons. But the reality is, as much as it's a leveraged commodity and there's a lot of sort of play going on in terms of silver markets and the manipulations we hear about, the reality is to physically build things, you need physical silver. And there's just not simply enough physical silver to meet the demand that we have.
That's outstanding. I really appreciate that. All right. So this has been a wonderful conversation, as always. Before we wrap up here and I ask Nomi our final question, I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with Nomi. They're all put up there. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. For our premium subscribers, we just launched The Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analyses and insight reports into the broader metals and miners market, or a deep dive into a specific metal or a specific miner. So far this year, we've posted 3 reports that have been published. They're a must read. They contain a lot of intelligence. The most recent report was published on February 5th. It was written by copper expert Simon Hunt, and it details the coming copper cycle that many investors are excited about. So head over to metalsandminers.substack.com, subscribe, receive the free gift, and while you're there, check out the premium subscription that includes the Inner Circle. Also, I'm positive that you've enjoyed the conversation with Nomi as much as I have and always do. Please let her know, hit that like and subscribe button, and leave a comment below the video. All right, Nomi, everyone who's paying attention to the uranium space, which you've touched on here and there in this discussion, understands very well that the uranium market is experiencing a serious supply deficit and a simultaneous significant demand resurgence. That's not something lost on the investor class. Yet the price of uranium has languished over the last year. Equities have followed the price of physical uranium downward, and it's really damaged investor sentiment in the space. I'm sure you've felt it, seen it, read it. Would you speak into the investor right now regarding this situation, where you expect the price of uranium to go in 2025, industry sentiment, the equities, et cetera, looking to uplift the uranium investor group?
Sure. So a couple of things. One, obviously we also recommend and have some excellent uranium companies in our portfolio. We continue to like them, and I continue to be bullish about the medium-term and long-term aspects of uranium and uranium miners. I think what happened last year, and we did see uranium hit new highs in the very beginning of 2024, is a series of tailwinds that work together, but in many ways they were related to government support and bipartisan acts that had been culminating, and I was involved in the language of a lot of them, that had been culminating for 2 years going into the beginning of last year. And what they in composite basically stated was that from a national defense perspective, uranium and nuclear energy were important. From a technology perspective, it's important to invest in whether it's small micro technology, SMRs, and so forth. That it's important to have allied sources. That it was important to look at the various aspects of the economic, energy, and national security efficiencies of nuclear power and the uranium that powers that nuclear power. All of that stuff was happening with a lot of fanfare to whoever was paying attention, right? It's not like the whole world is not looking at NVIDIA and it's looking at uranium miners. That's just not what happens. But anybody who was in the space was very aware that there was a multitude of factors, including the global pivot to having to triple the amount of nuclear energy power by 2050 and so forth. There's a lot of things happening in the space that provided momentum to those within it and to some people outside of it to pay attention at the end of the day to uranium and uranium miners. And a lot of that had the impact of pushing uranium up, starting from really the Russia accelerating the invasion of Ukraine back in 2022, but all of the steps that happened along the way over those couple of years. We haven't had anything since then, or basically in the last sort of since last summer, which was just sort of a knock-on extra act in the nuclear space to add on anything new. We've had more countries pledge to a 2050 tripling of nuclear. We've had things happen, but nothing extra that wasn't already in play has happened. And so what that has meant is a little bit of a lack of attention to this space. And what this space needs is not just the knowledge. As you said, we all know there's more demand than supply. We know it takes a minute to run these mines. We know all that. But that's what happened. And as a result, the miners came down, uranium prices came down. That extra little bit of, the economy's not doing as well, maybe, which like popped in for copper and silver as well, kind of came into play. A lot of things came into play with nothing on the other side. That's just a fact. It has a short memory. Things have a short memory in the market, especially when you're paying attention to NVIDIA or whatever. So what is happening now that can change that and move it back up to where we're at, instead of like in the 70s, but going back to your 80, 85s, 90s throughout this year, and then, possibly hitting 100 again. I don't think this year, but maybe next year. Well, what that requires is more conversation by this administration, not just supporting uranium as a critical mineral. We've talked about that, but in general, to support the technological expansion, domestic allied initiatives, processing, and so forth of uranium and nuclear power. It just hasn't happened yet. So there's a bit of uncertainty as to how is it going to manifest. Are we just going to be talking about fossil fuels and a little bit of other stuff on the side? Are we just going to reclassify uranium as critical mineral? What's going to actually happen? Will Congress come up with more acts to facilitate the funding of these initiatives from a processing perspective with the money that's already been allocated? There's things that need to line up or reline up for, I think, that attention that drove a lot of what we saw in those 2 years to come back into play. And those things are possible. It's just that so far into this administration and in the very beginning of it, there hasn't been a lot of conversation in Congress or in the administration as to, all right, we're all in on nuclear right now, just like, we're all in on fossil or whatever else the case may be to solve our energy problem. I think that can happen. I think the people are in play in Congress on a bipartisan basis, as well as in the administration from a department perspective. I just think we haven't, to belabor this point, we just haven't seen that all come together yet this year. And that is what is required. But patience is also required.
Yeah. So it sounds like, we have all this great news happening still, but all of the great news that's even coming out today is still kind of news that was baked into the cake. And so the cake is baked, and here we are, we're sitting in the low 70s, and, we spiked to 105 down to the 70s. And, we saw the spike in the mining group, and then they've come back down, not completely, but they've lost some of that luster, because everything that was baked into the cake is still there. So, but when we get some new toppings for the cake, then we'll see a rise again, because the setting is good. It's positive. It's filled with a lot of great things, and not just the story that we know, but all the new things that keep coming out that are standing behind the story. Really, yeah. All right. Nomi, thank you for coming on to Metals and Miners and for being so generous with your time, analysis, and ideas. It's always wonderful to spend the time with you. Would you summarize your views in a condensed fashion as you can, and then let everybody know where can they learn more about your work and how they can connect with you?
Sure. So on average, I'm a bull on commodities this year, some more than others. So, I mentioned gold, I mentioned copper, a little bit less on silver and uranium this year, but definitely looking at miners on uranium, looking at miners on gold, miners on silver. I do think from the standpoint of technology, I'm looking at the technology companies that have specific actions that can be used by cyber, by national security, by things like infrastructure development and making energy more efficient. And to look at my stuff, you can go to prinsites.substack.com. Multitude of products there, some of which are very specific to stock recommendations across the topics that we examine, as well as complementary material on just trends that are occurring, whether it's the Fed, the government, other governments, or so forth, and ask questions and chat and join. And I also want to thank you, Gary, so much for being so amazing at putting this material together and out, and the quality, and how much you really do provide your subscribers.
Thank you so much. That is really sweet of you. I appreciate it. Nomi, it's always a joy. I look forward to having you back on sometime soon. By the way, before I wrap up there, I've been following you for quite a long time. So I'm going to have all that information up on the screen. Whoever's not following but is listening, you need to follow Nomi. She is a wealth of information. Are you going to be down in Boca again this year?
I am, yes.
Wonderful. So at the Rule Symposium, if you guys can get down to the Rule Symposium and if you just listen to Nomi speak, it is well worth the price of admission. That's in July. I don't know the dates yet. You might know the dates.
It's somewhere between, it's like the first week of July. It's after July 4th and before the 11th. Okay.
So everybody try to get down there, or at least tune in virtually and listen to what Nomi's going to share. It's always critical information. Her Prinsites Global is incredible. Get on there. I'm going to have the link on the screen. Click through, connect with her. You're also on Twitter, right?
Yes.
Or X. Yeah. All right. Well, hey, thanks again for coming on. Always look forward to speaking with you. And everybody else, thanks for watching.
Thank you.
Everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with Nomi. They're all put up there. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. For our premium subscribers, we just launched the Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analyses and insight reports into the broader metals and miners market, or a deep dive into a specific metal or a specific miner. So far this year, we've posted 3 reports that have been published. They're a must read. They contain a lot of intelligence. The most recent report was published on February 5th. It was written by copper expert Simon Hunt, and it details the coming copper cycle that many investors are excited about. So head over to metalsandminers.substack.com, subscribe, receive the free gift, and while you're there, check out the premium subscription that includes the Inner Circle.